Today we're going to look at the company Korn Ferry, headquartered in the United States and traded on the New York Stock Exchange under the ticker KFY. Please stay tuned for the important disclosure information at the conclusion of this video. Korn Ferry originated in 1969 when co-founders Lester Korn and Richard Ferry left their roles at a Big 8 accounting firm to launch a boutique personnel agency in Los Angeles. While it began with a vision to provide a broad range of consulting services, the firm quickly gained international prominence by specializing in high-level executive search. The company's trajectory on the public markets was notably nonlinear. It first held an initial public offering in 1972, but returned to private ownership just 2 years later to focus on growth without the pressures of public reporting. During the 1980s, it cemented its status as the world's leading search firm before eventually re-entering the public market with its second IPO on the New York Stock Exchange in February 1999. The 21st century marked a fundamental evolution for the firm as it transitioned from a pure-play headhunting agency into a global organizational consultancy. Under the leadership of CEO Gary Bernison, the company executed a series of transformative acquisitions, including the purchase of leadership development specialist Lomanger in 2006 and the landmark $452 million acquisition of the Hay Group in 2015. These moves allowed Korn Ferry to integrate compensation data and talent strategy into its core recruitment offerings. In 2018, the company finalized this transformation by rebranding as a single, unified entity, sunsetting its historic sub-brands to present a holistic approach to the science of people. Korn Ferry operates as a premier global organizational consulting firm, positioning itself as a single source for leadership and talent solutions. The company's business model is built around synchronizing an organization's strategy, operations, and talent to accelerate performance. It delivers value through 5 primary business segments: consulting, digital, executive search, recruitment process outsourcing, and professional search and interim. These divisions allow the firm to support clients across the entire employee lifecycle, from designing organizational structures and compensation packages to identifying and developing high-level leaders through data-driven assessments. The company serves an elite global customer base, including 99% of Fortune's most admired companies. Its clients span virtually every major industry, with significant expertise in financial services, healthcare, consumer markets, life sciences, and technology. Korn Ferry maintains a massive international footprint, operating in 111 offices across 53 countries. Geographically, the business is highly diversified. While the Americas region traditionally represents the largest share of revenue, roughly 57 to 58%, the Europe, Middle East, and Africa and Asia-Pacific regions are critical growth engines, with EMEA recently accounting for 30% of total fee revenue. By leveraging a proprietary database of billions of data points, Korn Ferry integrates human expertise with scalable technology platforms, such as the Korn Ferry Intelligence Cloud, to help international enterprises bridge the gap between their current capabilities and their future growth potential. The 2-decade arc of Korn Ferry's financial history reflects a deliberate transition from being the world's leading headhunter to becoming a high-margin data and consulting powerhouse. In the early 2000s, the company was essentially synonymous with executive search, which accounted for more than 70% of its revenue. During this period, the firm's performance was highly sensitive to global economic cycles, as seen in the revenue dips following the 2008 financial crisis. However, the leadership team recognized that to achieve sustainable long-term growth, they needed to decouple their success from the volatility of transactional recruitment. This led to a period of aggressive, transformative acquisitions that began in the mid-2000s. The 2006 purchase of Lomanger brought essential leadership development tools into the fold, while the 2015 acquisition of the Hay Group, a massive $452 million deal, fundamentally changed the company's DNA. This integration created the modern consulting and digital segments, allowing Korn Ferry to provide deep-dive advisory on organizational structure and compensation. By the late 2010s, the firm had successfully built a digital division that commercialized its proprietary data, creating a recurring, high-margin revenue stream that now accounts for a significant portion of its total fees. Today, the RPO and professional search segment serves as a critical growth engine, as large enterprises increasingly outsource their entire talent acquisition function to Korn Ferry. This shift has balanced the portfolio. While executive search remains the flagship service, the combined revenue from consulting, digital, and RPO now often outweighs the core search business. This diversification has proven vital in recent years, allowing the firm to navigate the post-pandemic labor market with record-breaking results and a robust balance sheet that prioritizes both technology investment and shareholder returns. This financial analysis of Korn Ferry examines the company's ability to convert total revenue into operating cash flow and, ultimately, free cash flow over a 20-year period. At the core of Korn Ferry's financial narrative is its evolution from a specialized executive search boutique into a global organizational consulting powerhouse. This strategic shift is reflected in the steady, multi-decade expansion of its top-line revenue, which grew from roughly $540 million in 2006 to approximately $2.76 billion by the 2025 fiscal year-end. This growth was not merely organic. It was fueled by major acquisitions like Hay Group in 2015 and Miller Heiman in 2019, which diversified the firm's revenue streams beyond cyclical hiring trends and into more durable, recurring consulting and digital subscription models. Beyond direct service costs, Korn Ferry manages substantial selling, general, and administrative expenses. These include the firm's global real estate footprint, marketing efforts to maintain its premium brand, and the administrative backbone required to support over 9,000 employees. Interestingly, while the firm invests heavily in its digital platforms, it does not typically report a separate research and development line in the same way a software company would, instead embedding those innovation costs within its broader operating structure or capital expenditures. The transition from net income to operating cash flow requires adjusting for non-cash items and working capital fluctuations. Depreciation and amortization are significant non-cash expenses that are added back, but the most notable non-cash adjustment for shareholders is stock-based compensation. SBC serves as a vital tool for aligning the interests of senior partners with shareholders, though it represents a real economic dilution that must be subtracted from free cash flow to understand the true cash available to owners. Working capital also plays a dynamic role. As a service provider, Korn Ferry's cash flow is sensitive to the timing of accounts receivable versus accounts payable. Furthermore, contract liabilities, representing cash collected upfront for work not yet performed, act as a source of cash that can precede revenue recognition, providing a helpful float during periods of expansion. Ultimately, the firm's free cash flow provides the clearest view of its financial health. After accounting for capital expenditures, CapEx, needed to maintain its infrastructure and digital tools, the remaining cash is used for debt service, dividends, and share repurchases. Over the past 20 years, Korn Ferry has demonstrated a disciplined approach to this capital allocation, balancing the need for aggressive acquisitions with the return of value to its investors. By subtracting stock-based compensation from the traditional FCF figure, we arrive at a dilution-adjusted cash flow that offers a conservative and transparent look at the firm's underlying profitability and its long-term capacity to sustain growth in a competitive global market. Korn Ferry's financial history since 2006 provides a masterclass in how a professional services firm can transition from a lean, debt-free talent shop into a global consulting powerhouse with a sophisticated capital allocation framework. In the first decade of this period, from 2006 to 2014, the company's balance sheet was remarkably conservative. It carried essentially zero interest-bearing financing debt, preferring to fund its growth and boutique acquisitions entirely through internally generated cash flow. During this era, capital return to shareholders was limited almost exclusively to share repurchases, which were used strategically to offset the dilution of stock-based compensation. The firm did not even pay a regular dividend during this time, focusing instead on hoarding cash and maintaining a fortress balance sheet to weather economic cycles. The turning point in this narrative occurred in fiscal year 2015 and 2016. This period marked a fundamental shift in the company's risk appetite and strategic vision. To facilitate the transformative $452 million acquisition of the Hay Group, Korn Ferry entered the debt markets for the first time in a significant way. By securing a term loan and revolving credit facility, the company signaled that it was willing to use financial leverage to accelerate its evolution into a data-driven advisory firm. This acquisition didn't just add revenue. It added a massive library of intellectual property that improved the quality of its cash flow, making it more predictable and less reliant on the volatile executive search market. As the company entered the 2020s, its capital allocation strategy reached full maturity, characterized by a balanced approach described by CEO Gary Burnison. The table reveals a consistent and growing commitment to dividends, which were initiated in 2015 and have scaled alongside the company's rising profitability. Even more telling is the aggressive share repurchase program, which recently saw a $250 million increase in authorized capacity in late 2025. This allows the firm to return nearly $100 million annually to investors while still maintaining a net cash position, where total cash and short-term investments significantly exceed financing debt. The resilience of this model was tested and proven during the 2021 to 2022 post-pandemic boom. While many firms were struggling with labor costs, Korn Ferry generated record true free cash flow, allowing it to fund a string of digital and RPO acquisitions while simultaneously paying down debt and raising dividends. By 2025, the firm has established a self-sustaining cycle. High-margin digital services generate predictable cash, which is then used to pay for the talent that drives the consulting business, with the surplus being returned to shareholders through a disciplined mix of buybacks and quarterly payouts. This table serves as definitive evidence that Korn Ferry has successfully decoupled its growth from its debt, proving that a consulting firm can be both an aggressive acquirer and a reliable returner of capital. Korn Ferry is led by its long-tenured president and CEO, Gary Burnison, who has been at the helm since July 2007. Burnison originally joined the company in 2002 as Chief Financial Officer before transitioning through the role of Chief Operating Officer. Under his leadership, the firm has undergone a massive transformation from a search-focused boutique to a global consulting powerhouse. His compensation reflects this strategic growth. For the 2025 fiscal year, Burnison received a base salary of $1 million, while his total compensation reached approximately $15 million. Ownership of the company is dominated by massive financial institutions, highlighting the market's trust in Korn Ferry's mid-cap stability. Institutional investors own approximately 97% of the company. Individual insiders, including members of the executive team and the board of directors, own about 1% of the outstanding shares, providing them with significant skin in the game worth millions of dollars. The remaining portion, roughly 2%, is held by the general public. This concentrated institutional ownership suggests a high level of professional confidence in the firm's long-term consulting and digital-first strategy. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. The bull case envisions Korn Ferry successfully wiring its business to the global AI and automation revolution. In this scenario, the company's digital segment becomes its largest revenue driver, as its proprietary data on billions of talent points becomes indispensable for companies restructuring their workforces for an AI-first world. High-margin subscription revenue pushes operating cash flow margins toward the 16% mark, allowing for aggressive dividend hikes and massive share buybacks. The catalyst here is AI monetization, where Korn Ferry doesn't just consult on AI, but provides the essential software tools to manage it at scale. The base case reflects a steady continuation of the current, balanced strategy. The firm maintains its status as a market leader, growing slightly ahead of global GDP by capturing market share from smaller, less tech-enabled recruitment firms. Growth is driven by a mix of mid-single-digit organic expansion and periodic, disciplined acquisitions in the professional search and RPO sectors. Dividends grow at a healthy clip, and share repurchases effectively neutralize the dilution from stock-based compensation. This scenario assumes the global economy avoids prolonged depressions, allowing Korn Ferry to leverage its diversified segments to smooth out the typical volatility of the executive search cycle. The bear case considers a future where intense competition from Big Four consulting firms and niche HR tech startups caps Korn Ferry's pricing power. In this story, the human touch of executive search becomes increasingly commoditized by low-cost automated platforms, and the firm struggles to maintain the high margins associated with its specialized advisory work. Revenue growth stagnates at near-inflation levels, and a larger portion of earnings must be diverted to stock-based compensation just to retain top talent in a competitive market. Capital allocation shifts toward defense, with dividend growth slowing and acquisition spending focused only on small, necessary tech tuck-ins to prevent obsolescence. In the bull case scenario, we assume the following: revenue growth at 12%, operating cash flow margin at 16%, CapEx growth at 6%, stock-based comp growth at 5%, dividends growth at 14.5%, stock repurchase at 13%, acquisition spending in the next 20 years at $5 billion. Stock repurchases assumes price-to-sales ratio of 1.2. With this discounted at 7.5%, dividend model yields $96 worth of value per share in 20 years, $275 in 30 years, and $752 in 40 years. In the base case scenario, we assume the following: revenue growth at 6%, operating cash flow margin at 13%, CapEx growth at 4%, stock-based comp growth at 4.5%, dividends growth at 8%, stock repurchase growth at 5%, acquisition spending in the next 20 years at $2 billion. Stock repurchases assumes price-to-sales ratio of 1.2. With this discounted at 7.5%, dividend model yields $44 worth of value per share in 20 years, $77 in 30 years, and $119 in 40 years. In the bear case scenario, we assume the following: revenue growth at 3%, operating cash flow margin at 10%, CapEx growth at 1%, stock-based comp growth at 3%, dividends growth at 4.5%, stock repurchase growth at 1%, acquisition spending in the next 20 years at $0.5 billion. Stock repurchases assumes price-to-sales ratio of 1.2. With this discounted at 7.5%, dividend model yields $27 worth of value per share in 20 years, $37 in 30 years, and $46 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.